Friends, welcome to our consulting channel. In this video, we will be discussing investing in the stock market for beginners. The goal of this channel is to empower you by providing financial education to guide you toward your investment journey. The choice of what to do with your money should be consistent with your dreams, goals, desires, and aspirations in life. Remember, this is not financial advice. It is an educational tool to aid in your research and making financial decisions. A lot has been said about investing in gold, cryptocurrency, video coming soon, real estate, and other assets that can double, triple, and/or quadruple your investment over time. However, in our opinion, the stock market remains an important asset too important to ignore. As we know, America is the largest economy in the world, and the majority of the companies responsible for this are listed on the stock exchange. In fact, these 7 American companies, Microsoft, Nvidia, Apple, Meta, Facebook, Amazon, Google, and Tesla, are worth as much as all the stocks trading in Canada, Japan, and the United Kingdom combined. We bring this information to you watching this video for awareness and to use this knowledge to potentially create life-changing wealth. The process of investment can be intimidating. We will provide basic explanation to simplify the process. What is stock investing? Investing in stocks is basically putting your money into shares, stocks, index funds, exchange-traded funds, ETFs, and other publicly traded assets with the hope of getting more money back in the future by way of compound interests. The point of investing is to keep your money safe from inflation. On average, the dollar loses about 2% of purchasing power every single year due to inflation. The value of the dollar does not go far enough as prices are skyrocketing at the grocery stores, increase in gas prices and rents without any increase in wages and salary. If you do it right, the stock market is an asset to own that can protect the dollar against inflation. Friends and family often ask, isn't investing risky? The real answer is that not investing is riskier because you are guaranteed to be a lot poorer decades from now. And investing in stocks allows you to break out of the idea of trading time for money and achieving financial freedom. The Standard & Poor's 500, also known as the S&P 500, tracks the stock performance of the largest 500 companies listed on the stock exchange in the United States. If you invested $500 every month into the S&P 500 for 30 years, with an average yearly return of 10%, you will have a little over $1 million at the end of those 30 years. Incredible, don't you think? You would have invested $180,000 of your own money over the 30 years, putting $500 into it monthly, and then investing via compound interest did the rest for you, getting you to over $1 million. That is $859,000 of free money. Do not be intimidated. You should be excited as you start your investment journey. I will caution you here that time, patience, and discipline is required to enjoy the benefits of long-term investing in the stock market. The ultimate goal in your investment journey is to work less, earn more, and be financially free. If you currently have a job, the first place to start is to check your employer's 401k, which is a retirement plan you get through your job. If you have a 401k plan at your job, of which an amount comes out of your paycheck every pay cycle, which is then placed in your 401k. This money then gets invested for your retirement. It is important to check on your 401k and make sure that a percentage of your paycheck is in fact going into your 401k, because that's the easiest way to get started on investing. In addition, if you have an employer match, where your employer will match every dollar that you put into your 401k, it is just another job benefit that you may have. And if you have it, you should definitely take advantage of it because it's free money that your employer is going to give you, and there's no reason not to. It maxes out. The good thing about a 401k is that the provider of your 401k manages the investments for you, so it should already be invested in some good index funds, which we'll talk about later. The next step is to open an investment account on your own. Think of this as a fruit basket. The basket is your investment account. Open with any platform of your choice: Fidelity, Vanguard, Schwab, Robinhood, and others. The fruits to buy and hold in your baskets are the shares, stocks, index funds, ETFs, and other investment assets to buy from the stock market. There are different types of investment accounts such as Roth IRAs, traditional IRAs, and health savings accounts. These accounts are different in the way the investment gains from them are taxed by the government. There is a family of accounts called retirement accounts, and these are tax advantaged because the investment gains are taxed differently compared to taxable accounts, which are often non-retirement accounts. Investments held in taxable accounts will get taxed capital gains tax income. As a beginner, you want to focus and max out your investments in the tax-advantaged accounts. The tax-advantaged accounts are earmarked for retirement, and you have to keep money in these accounts until the retirement age of 59 and a half. If you withdraw before the retirement age, you might be subject to some penalties and fees. It is smart to start and max out the amount to be invested in the retirement accounts due to the tax advantages that they offer. A good tax-advantaged retirement account is the Roth IRA. A Roth IRA is an account that allows you to put money into it after tax, and then whatever you buy in the Roth IRA, even if those investments go up like 100 times, you don't owe any taxes on those capital gains, provided you kept it there until retirement. And then later on when you retire, you can withdraw the money also tax-free. This is an amazing investment tool. And in our opinion, we think everyone must own a Roth IRA account in 2024. The Roth IRA contribution limit for 2024 is $7,000 for those under 50 years old, an additional $1,000 catch-up contribution for those 50 years and older. Now, we will assume in step 3 that you are going to open a Roth IRA by transferring money into the Roth IRA investment account from your regular bank account. Once you've transferred money into the Roth IRA, the next step is really important. A lot of people actually forget this. They don't invest the money sitting in their Roth IRA. Therefore, I'm going to reiterate that a Roth IRA or an IRA account is just an account. It's not an investment, so just because you have money sitting in your Roth IRA doesn't mean that you are investing it. Remember to invest the money sitting in your Roth IRA. Step 4 is the best part and the fun part. That is to decide which investment assets to invest into. For the purpose of this video, the choice boils down to 2, stocks or bonds. Let me explain. Stocks are basically little pieces of ownership in companies. When you own a stock, you actually own a tiny slice or a little percentage of a very, very large company, which is pretty cool because that also means that when that company makes money by way of profits, if you are a shareholder, you get a little slice of those profits as well as dividends. For example, if you love Apple, you can buy an Apple stock, thereby becoming a small percentage owner of Apple as a company. A center percentage of the profits and dividends is yours if Apple makes profit. Another way to invest in stocks is to buy them as part of a fund. Think of a fund as just a bundle of different stocks, and the benefit of a fund is that it gives you instant ownership into hundreds, sometimes thousands of different companies all in one fund. To keep with our fruit basket example, think of buying the individual stock as buying one fruit instead of buying multiple fruits in a fruit basket, similar to buying funds. The benefit of buying a fund is for diversification. Diversification is safety in numbers. Essentially, by investing a little bit into lots of different companies, your financial future is not dependent on whether one company does well. It depends more on a whole subset of companies, which is a lot safer than owning a little slice of one company. If that one company goes down, your investment is gone, versus a fund protects you from the ups and downs in the economy. It is unlikely that all the companies in your funds will go down at the same time. Diversification offers a level of protection for your money investment. Investing in funds are safer. So far, I hope I have convinced you to invest in funds versus individual stocks. If you agree, let's actually talk about how to actually choose a fund to invest in. An important factor in fund selection is to choose a fund with low fees, sometimes called expense ratios. Expense ratios are the management fees to manage the stocks in the fund. The investment company that owns the fund will charge a tiny little percentage that they take off the top of your investment in exchange for giving you that convenience of owning all those stocks in one easy fund. These fees varies from 0 fees to as high as 2% of your portfolio yearly. It is important to avoid funds with high expense ratios. The fees will add up over the life of your investment in the funds. The rule of thumb is to look for funds with low fees, minimum of 0, a max of 0.5% in fees. There are plenty of funds with close to 0 in fees. It is important to stick with low expense ratio funds. This type of funds are called index funds. An index is a benchmark that has lots of different stocks in it. An index fund is a fund that is a mirror image of that index. The exchange-traded funds, ETFs, follows the same rule with some differences, but the same concept. For example, S&P 500 is an index. The index fund that mirrors the S&P 500 will be FXAOX, called Fidelity 500 Index Fund, while an equivalent ETF will be the Vanguard VOO, called Vanguard S&P 500 ETF. The S&P 500 is a measure of the health growth of the United States economy. In 2023, the performance was impressive with a growth rate of 21%. It is projected by analysts to grow by 30% in the next 2 years. There are other indexes like NASDAQ, Dow Jones Industrial Average, Russell 2000, all which represent the different sector of the United States economy and around the world. An index fund will just hold whatever is in the benchmark index. Compare this to an actively managed fund. An actively managed fund is where, instead of the fund's holdings mirroring that of a particular index, it is actively managed by a fund manager who, using his intellect and financial knowledge, picks what companies to place in the fund. In theory, it sounds great to have a fund manager, however. Studies have shown that these fund managers underperform the market regularly. Your investment will perform better in an index fund that just blindly mirrors the components of a diversified index rather than leaving it up to some smart person to try and outperform the index. Our recommendation is to go with an index fund with lower fees with as diversified a portfolio as possible. Your fund's performance will be better with less management fees. At this point in the video, let's spend some time to talk about bonds. A bond is a debt security like an IOU. Borrowers issue bonds to raise money from investors willing to lend them money for a certain amount of time. Instead of owning a piece of a company in stock purchase, when you invest in a bond, you are lending some money to a company. So that's how you make money with bonds, by earning the interest. In bonds, your money is safer, but if the company makes a ton of money, you don't really get to benefit from that because your interest yield is lower compared to a fund. There are less risk associated with bonds, and bondholders are paid first in case of company bankruptcy, while the stockholders are paid last. Therefore, investing in stocks give you way more upside, but you also have more downside, whereas with bonds you have less upside, but you also have less downside. For beginners, until you become comfortable with investing, a combination of an index funds and bonds are a good complement in your investment portfolio. Although stocks are riskier, they also have a higher potential reward, whereas bonds, they are less riskier. But they also have lower potential reward, and combined together they give you a really nice balance of the ideal ratio of risk versus reward. You can invest in bonds individually or bond funds, bonds that hold many different bonds, just like stocks. Bonds funds equally gets you some desired diversification. Assets allocation brings us to the idea of how much bond and how much stock in the selection of assets in our portfolio. The percentage asset allocation to stocks versus bond in a portfolio depends on your age and your risk tolerance. The assumption is that folks closer to retirement cannot afford the ups and downs associated with the market, therefore, a portfolio that is more geared towards bonds versus stocks. On the other hand, if you are younger, you can weather the ups and downs of the market with the benefit of time, realizing better return on the investment over time. However, it all depends on individual risk tolerance, goals, and aspirations. Jack Bogle is the founder of the Vanguard Investments, considered the father of index funds, suggests to own your age in bonds and the rest in stocks. A 20-year-old investor should own 20% in bonds and 80% in stocks, while an 80-year-old investor should do the opposite. This is a good rule of thumb. As a beginner in investing, it is important to understand this rule and adjust your goals as you see fit. We want to provide you some few tips regarding your financial well-being before you get excited and start investing in an S&P 500. It is important to cover some basic financial means of sustenance. First, ensure that you have an emergency fund for emergency situations so that you don't have to withdraw money from your investment account. You need to have a little bit of savings set aside in a high-yield savings account and some checking accounts for daily, weekly, and monthly living. The recommendation is for 3 months' worth of bare minimum living expenses so that if something happens, you can live off of that money instead of having to sell your investments early just to make rent. The whole rationale behind this is so that you don't have to ever sell your investments at a loss just because you need the cash. You want to be able to hold your investments for the long term because the market has literally never lost money over any 16-year period. Over the last 100 years, the stock market has never lost money. But if you sell after 1 or 2 or 3 years of holding the investment, there's no guarantee that you won't be selling at a loss. Therefore, your biggest advantage as an investor is having a long-term time horizon with access to an emergency fund if needed. Secondly, if you have any form of debt, especially a credit card debt, hold off on investing and focus on paying of your credit card debt first, because with credit card rates at 15, 20, or even 30%, it really doesn't make sense to invest in the stock market. The stock market returns about 10% a year, which will cancel out by the interest being paid on the credit card balance. So it makes more sense to pay off the cards first and then start investing. As you start your investment journey, we hope we have provided you with some informative material to get you started. Feel free to comment below the video. We love to hear by reading your comments. Invest that first $1, don't forget to keep investing monthly. Invest as much as you can, as often as you can. 10, 20, 30 years down the line, your future self will thank you. Beware of WhatsApp scammers. We will never ask for your personal information or solicit money from you. Thank you so much for watching. If you have derived value from this video, please don't forget to like, share, and hit the subscribe button. Remember, invest in yourself and stay amazing.